Welcome to the Goose Hollow Capital Weekly Market Update. In this edition, we'll recap recent events, preview what's on the horizon, and share some interesting charts and market price action that caught our attention. This week, we start with the Sahm rule. The Sahm rule, named after economist Claudia Sahm, is a recession indicator that has gained attention for its accuracy in predicting economic downturns. The Sahm rule signals the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.50 percentage points or more relative to the minimum of the 3-month averages from the previous 12 months. The real-time Sahm rule recession indicator stood at 0.53, just above the 0.50 threshold that typically signals the start of a recession. However, we are cautious about interpreting this data in isolation given the unique economic circumstances of recent years. First, the pandemic shock and the change in composition of the labor force could throw things off. Additionally, we have a lot more immigration, which is driving the unemployment rate while jobs continue to be added. The chart above shows that the S&P 500 underperforms for 3 months after rule is triggered on average. Next, an interesting chart from JP Morgan showing the implied probability of a recession based on asset price movements. They calculate the recession probability by comparing the current cycle peak to trough moves in various asset prices to those seen during previous recessions. There's a big disconnect between credit and equity markets compared to the U.S. Treasury markets. Mortgage rates continue to come down. We think the current mortgage market is more akin to ARMs, as people are borrowing at high fixed rates with the intention of refinancing as the rates drop. It will be interesting to see if the drop of about 100 basis points now drives mortgage refinancing activity. Next, an interesting table from BAML above shows the incremental performance improvement of adding gold and Bitcoin to a traditional US 60-40 portfolio. The additional assets are added in increments of 10% or 20%, reducing the original proportions of US stocks and bonds accordingly. For example, adding 10% gold to the portfolio changes the composition to 54% stocks, 36% bonds, and 10% gold. While the historical performance seems to improve the performance, Bitcoin has become more tightly correlated with tech stocks recently. The chart above shows the correlation between Bitcoin and the NASDAQ 100 over time. As you can see, historically, the correlation was low and negative at various timescales, but more recently it has become more correlated, removing the diversification benefits from Bitcoin. Next, after the recent news of layoffs from GM, Stellantis, and other auto companies, it looks like a difficult road ahead for auto sector. This may be due to rapid technological changes and competition from overseas. China has made significant investments in the EV sector, some of which is loss-making, along with Korean manufacturers becoming competitive. Korea recently developed a solid-state battery, which promises to extend the range of EVs further. The above employment charts look at statewide auto sector jobs. We see a shift in manufacturing employment in Ohio, a state with union jobs in the auto sector, to Alabama, a state with non-union jobs. As we discussed, China has made large investments in EV and auto sector. The chart from The Economist shows the percentage of loss-making industries. As we can see, the percentage of companies that are loss-making has increased dramatically. China and other countries with state-directed capitalism in Asia have dual objectives of employment and profitability. After China's property bubble burst in late 2023, China directed the country's savings toward making cars, chemicals, machinery, and chips competing directly with Europe. And China has been selling the resulting overproduction on global markets to avoid increased unemployment at home. Finally, a chart of the S&P 500 multiple over time shows that it is expensive. If the S&P 500 has the same earnings growth, but if the PE ratio mean reverts to historical median, we would get a low single-digit returns over the next decade. There is clearly large gap in valuations between the mega-cap tech stocks and rest of the market, so that presents an opportunity. This material is intended for information purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities to any person in any jurisdiction. The opinions expressed are as of July 2024 and are subject to change without notice. This information is not intended to be complete or exhaustive, and no representations or warranties, either express or implied, are made regarding the accuracy or completeness of the information contained herein. This material may contain estimates and forward-looking statements, which may include forecasts and do not represent a guarantee of future performance.